So to circle back to your question, you're actually incentivized to spend as much as possible on the rehab. And our basic underwriting, model starts a little bit differently than traditional underwriting. We look at the end game of, all right, what's our market rents? What's the potential income of the building? How much, debt can we service on that? Because ultimately we do hold these assets long-term. That is the goal, is to, have long-term cash flowing assets. So what's the most amount of debt we can put on there with some conservative terms and cash flow? And that's our rehab budget. So we're able to spend, in these small markets. I mean, without the credits, most of these projects aren't even viable.
Right.
And you get our current rehab is going to be somewhere. The current project we're working on, $2 to $2.4 million, and we're looking at nearly $1 million in tax credits, or tax credit equity produced. You couldn't spend $2 million in this market and ever make it close to pencil out. So, to finally circle back to your actual question, we're looking for the worst properties possible, because you don't get credits on the purchase of the property. So the ideal property, which is like the one we have right now, it's in a downtown sector. And I did fail to mention, requirements are the property has to be either a contributing property or in a contributing within a historic zone or a nationally recognized federal historic district.